Not too long ago, nobody invested in commodities. Now there's a ton of commodity funds out there. But Ed Egilinsky says the Direxion Index Commodity Strategy Fund is the best of the bunch. He's here to prove his case. Welcome, Ed. Tell me first, why do I need to own commodities? Stocks are doing pretty well this year.
Well, commodities have been around for a long time, and investors use them for diversification purposes because they tend to have a low correlation to stocks and bonds. And if we go through a higher interest rate environment or an inflationary environment, commodities have, at least historically, tended to perform well.
All right, so what exactly is in your fund? And you prefer a long, flat approach. What does that mean?
Well, most retail investors, if they're getting exposure to commodities, it's usually through long-only, broad-based commodity indices like the DBC or the GSCI or the Dow Jones UBS. And they have to be more tactical in nature because at times commodity prices could be volatile and they could go down. Our approach is more dynamic in nature. It is a long, flat approach. It consists of 12 commodities that either could be long if a commodity is showing a positive price trend, or will be in cash with a component that is showing a downward price trend. So it's possible to have some commodities that you have exposure to and other commodities that are showing a downward trend in cash.
So you're not actually owning the commodities, you're owning futures, right? I mean, you're not warehousing a ton of grain or oil in your offices in Midtown.
That's correct. We're trading the underlying futures markets, and we actually have what's called a smart roll yield that takes into account what's called contango and backwardation. In other words, rolling positions into the most cost-efficient futures contracts.
And how much of your fund or commodity should I own in my overall portfolio? Because you got to mix stocks and bonds and commodities wisely.
Well, we believe that an overall allocation to alternatives should be anywhere from 10 to 30%, consisting of different alternatives, including areas like commodities.
And what exactly is the big risk with commodities? Is it the volatility? What can go wrong? Because for a long time, people were worried about commodities for reasons like volatility.
Well, long-only commodity indices that can only benefit if prices rise, or individual commodities like gold, are going to have significant declines at times because they are volatile in nature. They could have declines of 50% or more. That's why we believe in more of a dynamic approach to commodity investing, where a commodity is either long if it's showing a positive price trend, as I said before, or if a commodity is showing a downward price trend, that commodity would be in cash.
And it's all about diversification, right?
It is. At the end of the day, that's what it's about for an investor, because you never know when the next bear market in equities or if we ever see a higher interest rate environment again.
The only free lunch on Wall Street. Thanks a lot for coming in, Ed.
Thank you.
And thank you for watching The Street.